Hello everyone, and welcome back to the Quant Lab. In our previous sections, we mapped statistical price deviation with the CCI and isolated effective institutional volume with the WVAD. But a truly comprehensive algorithmic profile must also account for human psychology. How aggressive is the buying pressure the exact second the opening bell rings? How much raw capital energy is required to push a stock to new highs after a massive overnight gap? Today, we're going to quantify these psychological forces using two combined frameworks, the ARBR indicator and its highly refined derivative, the CR energy mass index. The ARBR framework allows two distinct mathematical formulas on a single axis. They measure how far the daily highs and lows travel, but they anchor to completely different baselines. Let's look at their math formula. The AR indicator measures intraday sentiment. It uses today's opening price as its baseline. The distance from the open to the high represents immediate intraday optimism, while the distance to the low represents intraday pessimism. The BR indicator measures intraday energy. It uses the previous day's closing price as its baseline. By doing this, it incorporates the overnight gaps. Because overnight gaps require massive amounts of institutional capital, the BR line is structurally heavier and more volatile than the AR line, and will typically float above it. Before we look at the chart, I must warn you about a massive retail trap, the crossover fallacy. Because these two lines cross over each other constantly, beginner traders treat them like MACD golden or death crosses. This is mathematically flawed. Because AR and BR measure two entirely different baselines, the open versus the previous close, their intersections are meaningless noise. Instead, quantitative algorithms look for extremes. And while AR and BR, when they are both less than 50, it is on the oversold capitulation zone. And we must wait for a structural bottom K-line pattern to execute the long position. On the other hand, when AR is greater than 120 and BR is greater than 150, we are in the overheated warning zone. And again, we need to wait for the K-line confirmation to sell the stock. Look at this daily chart of Tesla following a massive rally. On May 14th, the price prints a Hangman candlestick, a structural topping pattern. Is this just a pause or a true reversal? We check the ARBR. So how to check it? We find the indicator. Check the indicator and search for ARBR. Sorry, ARBR. Then click it. You can see a separate window right here. So both lines, we have AR line and BR line. Okay. Both lines have surged deep into the overheated warning zone with AR reading 168 and BR reading 170. This extreme psychological overextension mathematically validates the K-line exhaustion. It is a definitive signal to take profits or short. Well, AR and BR are powerful. They have a vulnerability. They rely on the exact opening or closing prices, which can be easily manipulated by high-frequency algorithms or low-volume after-hour trading. To solve this, we use the CR indicator or energy mass index. The CR fundamentally upgrades the BR concept by replacing the previous close with the previous typical price. The true median cost basis of the day. This provides a much purer gravitational center of institutional capital. Because the raw CR line tracks pure daily volatility, it is incredibly spiky and erratic. If you trade its mechanical crosses blindly, you will be chopped to pieces by false signals. Therefore, modern trading platforms plot the CR line alongside a ribbon of 4 moving averages, typically 5, 10, 20, and 60 periods. This perfectly compresses the chaotic daily energy spikes into a stabilized multi-timeframe matrix, acting like an algorithmic trampoline for price support. Let's tie it all together with ultimate quantitative concept, Confluence. Before we look at the chart, note that we have a 100 baseline. So if the value of CR is greater than 100, we are in a bull regime. On the other hand, if it is less than 100, we're in a bear regime. And when CR is less than 50, it is the downward structural energy is effectively exhausted, and we need to wait for the K-line to confirm the trading. And then we do have a crossover trap, so I will leave you to read this comments right here. And let's look at one example. Right, so look at Tesla on March 10th and 11th, 2025. The price prints a bullish Harami, a classic bottoming structure. Again, we are going to study this in the next chapter. We check our ARBR indicator. The BR structural energy line has crashed to an extreme capitulation value of 40, with AR right alongside it at 55. Absolute panic. But we don't stop here. We cross-reference the CR, energy mass indicator. So how to use CR? Again, we search from the indicator and type CR. Then you can see this CR indicator. And we can see a separate window right here to see the CR. All right, so let's see CR here. All right. So on the same day, the raw CR line plugs to an extreme value of 30. If you look at here, CR value, you can see the 30 crashing well below our 50 earthquake threshold. When two completely independent mathematical algorithms, one measuring baseline sentiment and one measuring typical price mass, both scream capitulation on the same structural K-line, your probability of successful mean reversion trade skyrockets. And we can see that if you buy it right here, then we have an upper trend after that day. All right, rely on Confluence and never trade isolate nodes. That's all for today's lecture. See you in the next lecture.